land. So RIMS Australasia chapter respectively acknowledges the traditional owners and custodians of country throughout Australia and recognises their continuing connection to land, water, community. We pay our respect to elders past, present and emerging. Just a quick housekeeping note. We will be recording the presentation part of the session. You are welcome to ask questions throughout that if you would like. However, it will be recorded. But what we will do is on completion of the presentation, we will stop the recording and allow opportunity for you guys to ask any questions you have, and feel free to ask those questions without in sort of the, what do you call the saying, Chatham House rules. And at the, so yeah, I just wanted to call that out just so you're aware. Obviously, people online, feel free to either ask questions by unmuting yourself or also drop it in chat, and I'll keep an eye on that. If you're comfortable, feel free to put your camera on. If you're not comfortable, that's also fine to ask a question without camera on. I'll pass over to Eamon, who's our chair of the board, and he'll take it from here.
Great. Welcome everybody here in person and to everybody online. And my name is Eamon Cunningham, and I'm the president of the RIMS Australasia chapter. And on behalf of my chapter board, can I extend a warm welcome to everyone joining us today for our first Brisbane-based event in 2023. And the chapter aims to run a series of what we call risk roundtables throughout the year nationwide, but we're kicking off today in Brisbane. Today's topic is ESG, why it matters, and what a relevant topic it is, because fundamentally it's a series of risks that you frankly would choose to ignore at your peril. Can there be a more comprehensive series of risks that are both material and impactful to so many classes of stakeholders? I would suggest no, there isn't. It's all-encompassing. It's relatively new to some extent. So I encourage people that if they have a question, as one renowned Rupert Murdoch said, there's no such thing as a dumb question. The only dumb thing is the obvious question that should be asked that isn't asked. So please, Chatham House rules will apply and ask your questions. Why? Because this is very much a learning experience for all. Some of us are coming from the point of a great deal of knowledge in this area to what the hell does ESG stand for, and everything between those. So please ask your question and everybody will learn as a result. And so to the main event. And we have a truly impressive lineup of speakers today. And it's my pleasure to introduce to you. Welcome.
Sorry. No,
welcome to Sophie Griffin, ESG leader, Marsh Advisory Pacific, and an old friend of mine from Westfield, Briley Jabir, head of FinPro Corporate Specialty in Australia. And so with that, it's over to you, Sophie.
Thank you. Hi, everyone. So today, as Eamon has outlined, my presentation is going to be on ESG and why it matters. And I'm really happy for you to ask questions as we go. So this doesn't want to, there we go. Next slide, hopefully. So today we're just going to cover off what ESG is and what it means today, the confusion around ESG, what scenario analysis is, some key takeaways, and then Briley's going to join me and talk about ESG with respect to D&O insurance. And then we're going to talk about where to start. So how do we start, or how do we progress in our ESG journey? And we do, if we have time, we do also have a case study of some work that we've been doing. So just an ESG recap. So what is ESG and why is it so important? So E, S and G. So one way that we should actually put this is probably that the G should be at the top, but it doesn't sound as nice. So really ESG should start with governance. And what we refer to as governance captures how we govern is the E and the S. And then we have E being environmental risks, so climate change, energy efficiency, biodiversity, waste, deforestation. And then we also have S, which covers labour standards, wages, benefits, diversity, human rights. And why is it so important? The reason is why it's so important is because our key stakeholders and our strategic suppliers and organisations such as capital providers, they are really concerned about this. So ESG linked to financial outperformance, ESG may be linked to the cost of capital or restriction of capital. We also have regulation around ESG. There's actually already lots of ESG legislation in place. I mean, modern slavery is one, for example. We already have environmental laws in place, which we have to adhere to. Our customers, they're becoming more selective about their who they get goods from, and they want to know that there is a good ESG or sustainability story to their to the product. They want to make sure that the product doesn't have modern slavery in its supply chain. And we also have employees. So good ESG helps win the competition for talent. And I've directly seen that from clients that I've worked with, where they've had the ability to attract talent to areas where, in regional areas with a climate story that appeals to talent is very challenging. And partners and suppliers. So what you expect of your suppliers, but also what they expect of you as well. So we have seen actually provision of data relating to climate be declined to some industry because they don't want to partner with carbon intensive industries. So just a brief history of ESG. This is more just to highlight that it's not something that's just happened, and it hasn't just happened in the last couple of years. As early as the 1960s and the 1980s, when we saw the apartheid movement in South Africa, we definitely saw movement away from certain industry that seemed to support that area. And as we work through, we see that really it started to kick off in the 1990s and then in the 2000s. So in 2006, the term ESG was coined, and this happened with the United Nations Principles for Responsible Investment. But we see in 2020 that I can't put a full list under 2020 and beyond because basically it would be pages, but these are just some key takeaways. But this is what we see in terms of what's happening in the ESG space. So we see, for example, there's the Net Zero Banking Alliance, there's a Net Zero Insurance Alliance, which I'll cover off today. New Zealand, the United Kingdom, the European Union, Japan, Brazil, Hong Kong, they've all legislated TCFD reporting. Last year in December, the Australian Treasury issued their consultation paper. But what's really important actually is the last one is the EU. So the Corporate Sustainability Reporting Directive, CSRD, this was actually legislated in the European Union at the beginning of the year. So it means about 50,000 additional companies have to provide ESG or sustainability reporting. They legally have to apply that report, and they have to show targets and metrics. So statements can't just be made. You have to be able to show where you are, where you're going, and how you're getting there, and be able to show that through metrics. So you may have seen the Global Risk Report, but the Global Risk Report is produced by the World Economic Forum. MMC is a contributor to this. And what this does is a perception survey of, I think it's something like, there's two levels of surveys. One includes something around about 12,000 not at executive level, but people in business. And then there's a refined survey of a few thousand executives. And what they're surveyed is what do they think are risks that are concerning you with your business. And what this shows us in the short term is that we see that there are ESG risks there. So failure to mitigate climate change, natural disasters and extreme weather events. What's interesting is, and I will show later, is how they are linked to erosion of social cohesion in society as well. So, but as we look long term, we see that ESG risks actually largely dominate the long-term global risk outlook. So I thought I'd just talk about the confusion around ESG, because sometimes when we start talking about ESG with companies who come and ask us questions, we might get talking to the sustainability manager, we might talk to the risk manager, we might talk to the finance manager, and they all have a different view on what ESG means or sustainability means. So why do we see that people are confused about ESG? Because it seems that the build-up of ESG at the moment is that it's a new concept and it's still evolving. And this is because of the sheer amount of legislation and also the spotlight. And we can see also the litigation in this area, it is increasing. And the news and knowledge about it is evolving at a rapid pace. Different stakeholders prioritize different factors. So depending on who your stakeholders are, your customers may have different factors that they hold, whereas your capital providers might be thinking about different factors that matter to them, such as the net zero, transition to net zero, and how you're going to de-risk that. There's also lack of transparent risk rating or pricing. So we quite often see where someone will ask us, well what ESG rating do I use? What does it mean? What does it mean in terms of pricing? And there's really no coherent response to that, unfortunately. This is an umbrella term kind of for everything that's under sustainability. So it's so broad, and where do we start? And actually, Riley and I were talking about when we were preparing for this presentation, just how much that we could talk about. It is a really, really broad topic. And there's no standardization of definition of ESG or ESG measurement, which is unfortunate because we can't point anyone in any direction of saying, this is exactly what it is, and this is exactly how you measure it. But what we hope to provide you today is some information about looking at ESG risks and where to start and how to do that and what the next steps are. So ESG risk matters. So when we talk about ESG risks, we have to think about things like regulatory risks, so changes in laws and regulations. So it's not just thinking about the governance, but it's the forward planning about what may be coming and making sure our governance profile will reflect that. It's data privacy, so mishandling personal information or using personal information in the wrong way. Board composition and executive composition. There's actually some research that was released last week, and what was interesting is that it is a real risk because they found that there is direct correlation to boards that lack diversity in any type have the highest risk of greenwashing. And that might be because if you lack diversity, you're probably reinforcing the same views. Bribery and corruption, legal action, fines, reputational damage, and then also supply chain. So
sorry, guys.
it's okay.
Make a grand appearance.
So also how this can be modern slavery, so unethical or unsustainable supply chain causing reputational damage, but your supply chain may be also exposed to natural perils or climate change as well. So material ESG risk can directly affect your financial performance in the short term and most definitely in the long term. So it can help you and investors make informed decisions around your ESG risks and how you might mitigate those as well. The one thing I just talked today, and sorry for the people on the screen because I'm going to go up on point, is just when we think about ESG risks, so this is starting on how we think about ESG and making sure that we don't think about risks as a static point of view and we're only thinking about the risk itself, but we're thinking about how the risk is connected to other risks and how it's connected to stakeholders and our clients, and that we're making sure that we don't think that of risks in a vacuum. So I'll use the New Zealand floods. Those of you might be able to tell I'm a Kiwi, so it's quite an easy one for me to use. But when we talk about extreme weather events, so the flooding which occurred after Cyclone Gabrielle has occurred over large areas of cropping land and pastoral land. So we have the link to food crisis. We also had failure of critical infrastructure. So the railway lines are still down. They will be down for a very long time. Some sections of it may be in excess of 6 to 12 months. We had loss of communication. We had loss of water. So for the businesses in that area and also the wider community, we then also have the fact that it's going to change the economic standing point. We also have the issue that they also had some looting afterwards as well. So we can't just think about risks as, okay, we just have a flood and our asset gets damaged, but there's the wider issues that may happen, and then they may actually impact the viability of your business as well. So this is another example. So when we think about risk, we think about how our organisation impacts the world. So traditionally, sustainability is thought about how can I reduce my CO2? How can I reduce my waste? How can I be a more sustainable business? But to do that in completion, we also think about, well, there are these changes happening and there are these risks in the outside world. How do they actually impact my business? So if we think about organisations creating risks, so CO2, creating more cyclones or heat waves or increased flooding. We also have biodiversity and nature loss. So sometimes that can be quite a hard concept, thinking about how do I create a risk issue there. So when we think about using sustainable materials, so we think about use of timber, one of the interesting things about the flooding that's occurred in New Zealand is the amount of damage that's occurred because of the forestry industry. So there's huge amounts of slash, which is all the timber that's come down, and silt. And I think in some places you have in excess of 5 metres or 10 metres of silt that have buried houses, they've ruined cropping land. They can also cause landslides and sandstorms and drought. So we're making sure, and all of these then can go on to have an impact on your business. So they can cause interrupted or broken or restrictive supply chains. One of the things is when we have labour exploitation and we don't pull up society, this can mean the difference between whether a hazard becomes a disaster. So when we have, so COVID is actually quite a good example, is what we saw is those who were in the most insecure employment, they were the worst affected by COVID, by having to attend work, about where they might be living with multiple people in the same premises. So they were more likely to catch COVID in the first instance. The other part is that it also can increase things like claims. So as the climate changes, we may see increase in WHS claims because of heat stress and mental illness. Also legal liability risks. So there's one way to think about ESG risks is what is the risk of someone litigating against me because they think I have changed the climate or I have created a biodiversity risk issue. But then there's also the risk issue of, as the climate changes, if I was to do something wrong, the size of that risk could be substantially bigger. So a good example of this is the TND, or transmission and distribution. So in California and also in Australia, we've seen legal issues where fires being created and they've been sued for the fire that's happened because of their failed asset. But as the climate change, we're more likely to see increased likelihood that the event will occur because we're going to have more days that are hotter. We will have the ground will be drier. But then if the event does occur, you're more likely to have a more severe event. So it's not just whether I will get sued because of what I'm doing from a net zero perspective, but it's also because of my operations, could I have a higher likelihood of having a failure? And then if I was to have a failure, could the risk be much, much bigger? So one of the ways that we look at analysing this risk is by undertaking scenario analysis. And some of you may have done this through if you have gone down the route of TCFD or climate change reporting. So scenario analysis is when we look at not just at a static risk as it is today, but we start looking at what are future scenarios. So what could our future look like? And how can we make different assumptions about materiality or interconnectivity? And the reason why we do this is to improve decision making and to enhance transparency and to guide long-term planning. So I'll just give the example that's up on the screen. So this is a climate change example, and apologies, my area of expertise is climate change. ESG is really broad. I can't possibly be an expert on everything under ESG, but I'll just give this example here. So when we talk about climate, we can look at the different scenarios that might play out. So across the top here, we see no policy through the Paris Agreement aspiration. So we have two ways. We have what your aspiration is and what's happening globally. So we have to look at what is happening globally. So this might be, for example, when no policies are applied or when current policy is just followed, and that's globally, or it might be regionally. Let's say one of your key regions that you have supply with, they are very aggressive and go to the Paris Agreement aspiration, or let's say they have no policy, and also what your own aspiration is. And we can see that they're given the different areas of risk, we can have different risks that play out. So for physical risk, we might traditionally just think about this in terms of revenue loss and property damage. But if there was a physical loss, physical damage, we could also have revenue loss that occurs because of disruption to our supply chain. We might also then have increased labour costs or increased raw material costs because where we get our supply might be damaged. We could actually see that because where we operate, there's significant new capex that's required to shift old technology to new technology because maybe our customers or suppliers are demanding that we go there, or regulation is demanding that we go there. We may see increased liabilities. So interestingly, what we see is that under the Paris Agreement, which is or Paris aspiration, which is the most aggressive net zero target, is that liabilities trail off because we're controlling the ability of these events to occur and their severity. But under no policy, the liability risks become more severe because it's more likely that we will have an event that causes the loss, and it's more likely that the loss will be much larger. So it's just a good way to think about risk in terms of not just in the traditional sense of a risk spreadsheet that might have your risks and the ratings on it, but thinking about how this could play out in terms of time, so in the next 5 years or the next 10 years, and how it might play out under different scenarios as well. So just some key takeaways that we've got from the session, and then pass over to Briley, is so understand interconnected risks. So making sure that we understand if a risk issue is to occur, how it affects our key stakeholders or how our key stakeholders will affect us. Take a longer view of risk rather than just focusing on immediate risks. Think about what challenges may be coming to your organisation and how to build strategies to become resilient in the long term. These are just some risks that maybe to be on your radar. So sustainability does not equal low risk. So when we think about groundbreaking sustainability initiatives that people talk about, they may also create considerable risk to you. So they may reduce your supply chain. So because you are now thinking about getting a specific sustainable product that's taking you on your journey, but you can only get it from a handful of very selected suppliers. If one of those suppliers was to be lost or to leave the market for any reason, it may mean that you have significant supply chain issues or the cost of that product may go up. You may have increased risk to exposure to other risks. So I was talking with a client this morning, and they are having increased pressure to have EV chargers put within their buildings. So they have buildings like this, the commercial tower blocks, put in EV chargers. And they had thought about how it's going to bring down the CO2 emissions of their tenants, and they need it, and it's attractive, and it's going to help them with their transition. But one of the things that we need to think about is that it can create a fire hazard, an electric shock hazard, so third-party liability risks. There's also cybersecurity risk. So who actually takes these risks on? Do you get a third party to install them and it becomes their risk? Or is it your risk and someone connects their car to it and there's a cybersecurity breach? There's also what happens in the event of a power outage, and how do you remove these cars from the building? Increase in theft and vandalism. And then also, how does this play out in terms of changes to your insurance as well? We also had this issue with sustainable timber. So we had the biodiversity issue, but also the lack of attraction from a risk finance perspective, because it's not easily replaceable in the event of a fire, because it gets charred, it retains its strength, but generally it has to be replaced. And then there's very little knowledge about how it will actually respond. So insurers appear to be quite uneasy about those products. The other risk issue is the transition to net zero. I had the Net Zero Insurance Alliance, but really anywhere in your supply chain that is transitioning. And one of the things is making sure that your transition isn't risky. Anyone can say that they're transitioning to net zero, but you need to think of yourself as a partner with other people, because they are wanting to rely on you to transition, to ensure that their transition is smooth as well. So that will be a key point in maintaining stakeholders and making sure that they can trust you, and that it's not a risky transition. And then the last part is that cyber risks include AI. And I'm not a cyber professional. Like I said, I can't be across everything in real detail, but just making sure that we're thinking in the future and how AI is going to impact our cyber risks.
I'm sure everyone will agree that there's quite a bit to unpack there, Sophie. So as highlighted by Sophie, directors and officers and corporations are being held to account more and more as their organisations' environmental and societal impacts. So today I'll be considering this topic from my experience as a financial lines insurance broker, and in particular specialising in directors and officers insurance. Today I'm going to cover off three key areas: key trends and concerns for D&O insurers, D&O coverage considerations when it comes to ESG, and how to be best prepared for your 2023 D&O renewals. So from a D&O insurance perspective, ESG issues are in fact not new. D&O underwriters have been considering the various parts of ES and particularly G in their underwriting since D&O insurance was first introduced. I think the difference with and the focus that we see now on ESG is due to the shift in community, client, stakeholder and shareholder expectations, particularly after the Royal Commission into the financial institutions. It was really a turning point. From climate change litigation to diversity and inclusion and cyber and privacy, ESG issues are a key source of emerging liability for directors and officers. Investors, employees and consumers are increasingly expecting companies to actively address ESG considerations. And this shift in expectations, coupled with event-based litigation, aggressive litigation funding, plaintiff law firms, social inflation, and the never-ending securities class actions, particularly here in Australia, it has drawn the attention of D&O insurers to consider these issues even more carefully than they ever have before. So without a doubt, we have seen insurers turn their attention to ESG, and we are experiencing those clients that have good ESG practices receiving rewards from the insurance market. Now, in some cases, that's just being able to get the capacity itself, but in others, it can result in improved policy terms and conditions. So as we've already heard from Sophie, the world is evolving and it is evolving at different speeds, particularly with respect to ESG laws. And as risks also continue to evolve, companies face complex challenges. And with that, directors and officers need to contend with greater litigation risk, highlighting the need for adequate protection through a robust D&O policy. If we consider and take a quick look at the current insurance market conditions for D&O insurance, we'll see that in 2022, so last year, we started off with a deceleration of D&O premium increases and actually ended up with some pretty substantial or sizable premium reductions after what was 3 to 4 years of hard market conditions. And that was really as a result of new market entrants and increased competition in the D&O space. Looking into 2023, we have seen and we continue to expect that the current competitive landscape will continue. However, insurers are still taking quite a cautious underwriting approach, and they're really digging deep into clients' risks to understand them better. Risk differentiation and a demonstration of how you're a good corporate citizen will be key to success for 2023 renewals. Some of the key trends and concerns for D&O insurers are event-based litigation, not a new concept, but a continuation. Companies that have large-scale events that affect their profitability and ability to do business tend to experience negative feedback from their shareholders, which leads to claims and therefore increased regulatory attention also. Heightened regulatory environment. We've seen that across many industries here in Australia, and we've also seen that both the ACCC and ASIC have publicly announced that enforcement in relation to greenwashing claims is a priority for them this financial year. Continuous disclosure and misrepresentation risk in Australia has been looked at by D&O insurers for the last few years, and probably prior to that. It is of continued concern to those insurers. Investors and stakeholders are increasingly expecting companies to report on their ESG performance, regardless of whether it's mandatory. And this trend is driven by the growing recognition that ESG factors can have a material impact on a company's long-term financial performance and reputation. Whilst ESG reporting is not yet mandatory for all companies in Australia, it is becoming increasingly important for companies to disclose their ESG risks and opportunities to stakeholders. And whilst there are many example ESG reporting frameworks and standards, there is not yet a mandatory or consistent approach. And this effectively means that companies can report and measure on whatever they see as important or relevant, and whatever they choose to report on. And they can therefore influence the view of stakeholders. And those things that they're reporting on may actually not be relevant or important to those stakeholders at all. So ESG reporting progress is essential for companies to demonstrate their commitment to sustainability and to build trust with stakeholders. By using a variety of approaches, companies can ensure that they are effectively addressing ESG issues and communicating their progress to stakeholders. And we're seeing this more and more with companies reporting publicly with their sustainability reports and targets. ESG factors are increasingly seen by insurers as important indicators of a company's risk profile. Companies with strong ESG practices are viewed as lower risk, while those with poor ESG practices are viewed as higher risk. Insurers are digging deep into these areas, as experience has shown that previously well-rated and high-performing companies have actually suffered from claims demonstrating from poor ESG outcomes. And an example of that is the AUSTRAC matters against the big banks. Insurers are looking to get under the gloss of the shiny targets that are being shared. In some cases, their view is that they may be shared too quickly, with the expectations that they'll just figure it out as they go along. To describe targets as aspirational is not enough for insurers. They want to know the plan. And insurers may adjust their premiums, deductibles, or coverage limits based on ESG performance. Now, you're not alone as buyers of D&O insurance, because the D&O insurers themselves are also facing pressure from their own stakeholders, including their shareholders, their policyholders, and their regulators. Insurers that fail to take ESG factors into account may face criticism, and they may lose business to competitors that perhaps are more ESG focused. In this regard, and as Sophie mentioned, we have seen insurers and reinsurers, including the syndicates of Lloyd's, join the Net Zero Insurance Alliance, and that commitment to transition their insurance and reinsurance underwriting portfolios to net zero by 2050. Another reason why this matters to D&O insurance buyers is that in Australia, we have some of the broadest D&O policy coverage available globally. And depending on the policy wording, cover is likely to be available under all sections of your D&O policy, including various extensions like crisis response extensions. Coverage is available for ESG losses, including defence and other costs associated with regulatory, shareholder and activist action. A typical D&O policy covers individual directors for all acts, errors and omissions from their conduct as directors, and could therefore include matters relating to a number of ESG and climate change risks. Some of the allegations that may trigger a D&O policy are listed in this slide and include things like failing to comply with legislative reporting requirements, failing to disclose climate change liabilities, mismanagement of climate-related risks. Coverage may also be available for the entity itself in the event of shareholder litigation for those who buy a company's securities coverage. And there is a real risk, and this is a real risk, as share prices have been known to plummet following adverse news on ESG matters and climate change exposures. So whilst our coverage here in Australia is typically broad, there are always exclusions to consider. And some of those key exclusions are pollution, bodily injury, property damage, exclusions for fines and penalties sometimes, jurisdictional and territorial limitations should also be looked at. And whilst not commonplace in Australia, it is also possible that climate change exclusions may be introduced in future D&O policies should boards fail to demonstrate a prudent and diligent approach to climate risk governance or ESG in general for their proposals for insurance. So just in wrapping up, what should organisations be thinking about when it comes to D&O insurance? This slide provides some of the key D&O questions relating to ESG reporting. I won't go through them all, but when presenting to your D&O insurers, you should be prepared if insurers wish to dig into these areas and be really clear with them about how your company is describing your ESG risks to your investors. Take a proactive rather than a reactive approach to providing relevant ESG information as part of your underwriting submission and market presentations. Where possible, highlight diversification of your business model or implemented or planned measures that demonstrate a commitment to sustainability and climate issues. Demonstrate your sustainability commitments backed up by the targets, which should be time-bound and verifiable where possible. And remember, it's not all about climate change. Do not ignore the social and the governance factors. Highlight positives such as commitments to health and safety, zero tolerance for unethical practices or corruption in your business, and diversity of your board and senior management. And also, given the softening insurance market conditions, it may also be timely to evaluate your D&O coverage and your program structure. So take a good view on what your risks are and what you're comfortable with insuring and how you structure your D&O program. And lastly, be confident, be honest, and be transparent. Seek to grow and partner with your insurers for the long term, because at the end of the day, we're all in this ESG stuff together. I'm going to pass back to Sophie, who's just going to talk us through where and how we start.
Yeah. Thanks, Riley.
We did have a question. I don't know if you want to take it now or
Sure.
it's just in relation to supply chain. So the question, comment and then followed by a question. Supply chain has been used often in the presentation in context of ESG. Given the interconnectedness of ESG related threats, slide 2 or 3, supply chain infers a linear relationship with upstream and downstream risk. It would seem that the ESG narrative needs to shift to one of supply network as distinct from supply chain to be more relevant to today's highly complex, uncertain and interconnected society. Thoughts on whether the narrative should be changed?
From supply chain to supply network.
Yeah.
Okay. It's all right. So I think that's what we mean when we talk about supply chain. We don't mean just a linear chain of one thing to another. We are thinking about a network, and that's why it's really complex, and actually there aren't very many solutions out there for people to undertake to look at the risk of their supply chain, because as this escalates, what we've seen with COVID and is it the Ever Given? Is that the right name? The ship that went, is that our supply chains are really, really complex. So I agree with your comment, but I think when we talk about supply chain, I myself think about a network, because we don't just have one product, we have a network of products, and we have a network of suppliers that even those suppliers are interconnected as well.
Yeah.
But it was a good question in terms of identifying the fact that it's a network. So one of the things that we'll just talk about today is that we do have a place where to start if you are wondering where to start on your ESG journey. So we have two ways of looking at it. Both of them, there's no cost. I'll talk about the ESG risk rating and then the ESG pulse check. So the ESG risk rating, it is quite an intensive way to look at your ESG risk profile. It's 180 questions. And it's more to give you an understanding of where you are now. And it's based on the World Economic Forum, 18 categories when we look at economic risk. It covers off E, S, and G. And what you get back from that is a summation of, based on the business profile that you have, what are the ESG risk themes to you? And then there's the pulse check, and this is a much lighter, it's 12 questions, and it just gives you an instant viewpoint of, okay, do I have a sustainability manager? Where is my net zero goal? What are my aspirations based on what are the social issues that face me? And it gives you an instant viewpoint of where you are kind of today with respect to your peers. So it's just a way to get started. And then there are solutions for ESG risk issues. So do I have ESG risk issues? How do I respond to insurers' concerns? How do I estimate and manage my emissions? How will Nat Cat or climate change risk change? Can I model my transition risk? How can I build resilience? Do I need to disclose? And how can you help with climate and sustainability reporting? How does this impact my D&O risk? So there are a lot of things that can be done in terms of helping understand, do we have an issue? Yes, I have an issue. Can you tell me how big it is? What can I do to manage that issue? And how can I mitigate or transfer that risk? So I do have time for is there time for a case study?
Yeah.
How are we running? So I thought I'd just talk about something that we're hoping to replicate in Australia, but I thought this is a really good case study, what we've done in America. So in our American colleagues, what they've done is they've taken all the ESG information that we've collected about companies within the US, and they've looked at workers' compensation claims and liability correlations. And I won't get too much into the maths of it, but what they've found is that there is a direct correlation between higher S scores and lower workers' comp claims. So when you treat your employees and the wider society well, you benefit from lower workers' comp claims. There's also implied, although it's not necessarily that there's enough information to support it, but when you have a really high S rating, that actually even other liability claims start to become lower. So a good example, and it's not a really nice story, but in America there was an event where a passenger was locked in inside a toilet because they were having a medical emergency, and the staff believed that that person was a threat to the aircraft, so they locked them in there, and as a result that person was injured, and their family sued the airline, and they weren't successful. And the reason why they weren't successful is because one of the suggestions is because the airline has a really high S rating and a really high social trust within the community. So basically they were able to evidence all of the education they do of their staff and all of the information that they put out there relating to their social responsibility. And so they were able to say, well, we do train our staff, and they acted responsible. And so basically the agreement was that they did act responsibly, so therefore the claim didn't hold. Whereas conversely, if they had a low S rating, they weren't a trusted airline, maybe that may have played out differently. And there's just a few like p-values and x-mod colorations. Just look at that. I just want to go through that. Yeah, so any questions?